Equity Mates, from our mates at Spaceship. Investing made easy.
Welcome to another episode of Equity Mates. We are back on Tuesday, and my name is Bryce, and as always, I'm joined by my equity buddy Ren. How's it going?
I'm very good, Bryce. Good to be back for another day. Still enjoying the new background.
Still here?
Yeah. After some feedback on yesterday's episode, I've changed to a darker shirt, so hopefully that gives a bit more contrast.
Nice. Well, this episode we are bringing back one of our longtime guests and friend of the show, Andrew Brown. Welcome to Equity Mates on AusBiz.
Thanks, gents. Glad to be here.
So, for those of you who haven't come across Andrew before, he's the executive director at East 72, an NSX listed investment company. And we have had Andrew plenty of times on the show, particularly at the start of the year for our Bold Predictions episode. So you must go back and listen to those if you haven't already. But today we're going to be talking about inflation, listed investment companies, and maybe a bit around Sydney Airport as well. So should we kick in?
Let's do it.
So, Andrew, let's start with the discussion around inflation. There's obviously been a lot of chit-chat about it this year. Is it in existence? Is it not? We've seen growth stocks fall off earlier this year as well, and now they seem to start, coming back a little. So, how are you thinking about this inflation story?
Okay, let's frame the discussion, guys, and let's quickly look at how it's measured. What are the motive forces behind it? I'm going to discuss inflation expectations because that's the tricky bit, and then let's look at the impact potentially. First of all, how is it measured? There's a basket of goods which, say in America and also in Australia, that the Bureau of Labour Statistics in America and in Australia, basically the ABS think is representative of ordinary people. There's some interesting weightings in that basket. In the US, housing equates to 32% of the basket, or shelter as they call it, and about 24% of that is the imputed rent, so it captures to some degree the increase in house prices. That's a lagged effect, and there are some lags in that whole shelter thing which are going to come through later this year. Energy is about 7%, food's 14%, cars are 6 and a bit, and transport's 5%. And it's been things like cars that have driven it so far, but what I'm suggesting to you is that there's some other things that are going to drive it later on. In Australia, funnily enough, housing's only about 23%, transport's about 10%. We have a lot of other things like recreation. So the Australian basket, I don't think is quite so cyclically sensitive as the US basket is. The reason the basket's important, obviously, is in the US, these numbers come out monthly. In Australia, they only come out quarterly. So what are the motive forces behind it? There are two key forces behind inflation. That's something called demand pull and something else called cost push. Demand pull is basically when you get a lot of people want something all at once and there might be restricted supply. US housing is perhaps a good example of that at the moment. There hasn't been a lot of housing stock. Motor vehicles are like that at the moment because obviously new car production's hampered a bit. So to give you an idea, the average price of a new US car is now over $40,000 US. It's up about 15% over the same time last year. There are other things like cost push factors, and they're basically where some third-party event actually increases usually the cost of an input to production. So something like, say, copper. Certainly at the moment, the key one is the oil prices going up, and so that's really a cost push thing. And the other main cost push thing, which people really don't see because they don't look for it, are freight rates. The average cost of sending a 40-foot container from A to B around the world obviously varies dramatically, but it's around about $6,300 US And to give you an idea, a year ago it was about 1,700, and freight rates from China to Northern Europe are about $11,500 for a 40-foot container, and that's more than, it's way more than double what it was 6 to 8 months ago. And that's basically because you've got port blockages, you've got a shortage of containers, and so that cost push means if you're an importer in Europe importing goods from China, you've got to find a way to factor that into the price of your goods. The third aspect is the tricky one, is expectations. And it's tricky because this is the thing which either breaks out inflation or doesn't. And if inflation expectations really do break out, trying to stuff them back in the bottle is really difficult. We in Australia have got a really good sense of what that means and what it's about because of the 1990s here. Inflation in Australia really got broken by Bob Hawke, Paul Keating and Bill Kelty, who was then the president of the ACTU, having the wages accord. And the reason that broke inflation is because you had an accord that wages weren't going to go up more than the rate of inflation. If people expect there to be significant price rises, then they're going to demand more for their labour if they can. And they're going to have the expectation that things are going to be more expensive a few months down the track. So they either start buying things, hoarding things, and doing stuff like that, or if they're in a position to do so, put their prices up. One of the big ones in the US is gasoline, or petrol as we call it. It's the highest price for 7 years in the US because of the oil price going up. And things like petrol are very much in your face. You drive past gas stations all the time. The price is in huge numbers on the outside. The other thing that's going to start moving, I think you'll find, is potentially rents. And then also you're going to start to see some basic consumer goods increase in price. So what I'm suggesting is that the impact of these things is going to be delayed. It doesn't come all at once. And so what we're going to see, I think, as the year goes on, is that we're going to see more and more of these things priced into the change in CPI, or the inflation rate. Some of them are transitory. Okay, so some of the docks in LA and in China are starting to sort of free up a bit. So I expect the price of freight to come down a little bit from where it is. But there are other things that are actually going to be moving on the way up and that are not necessarily that transitory, which is going to be in the housing area. So I'd expect to see the change in CPI basically move ahead in both Australia, where the housing component's very dampened, and in the US. And of course, you would then expect that to feed through into bond rates and short-term interest rates.
So Andrew, in terms of positioning your portfolio for this inflation, you mentioned some of it's going to be transitory, some of it may be a little bit more permanent. How are you thinking about, some of those inflation hedges, gold, maybe even Bitcoin?
No Bitcoin here, Alec. One of the interesting things is the stock market's been really interest rate sensitive. If you don't believe me, go back and find some prices from about May the 12th and May the 13th, when the US 10-year bond was about 1.7. It's now about 1.45. And what you'll see is that, in a sort of reverse way, what you'll see is things that are sort of high growth, heavy, long duration stocks really rebounded dramatically. So if we look in Australia, Afterpay on those days was $84. It's now sort of 119. If you look at something like ARK, which is the ARK Innovation Fund, ARKK, that's a collection of heavy growth stocks. On that day, it was about $97, $98. It's now $128. So these things have rebounded dramatically, and I could give you some other examples that are even more extreme. So, number one, the market's very interest rate sensitive at the moment. So in my portfolio, I really don't have a lot of what I might call long duration stocks, or stocks with imputed hefty growth rates, then in fact, of course, I'm short a few. Not Afterpay, but I am short some other BNPLs. I think the only really long duration stock I've got in my portfolio that's got high growth is Spotify. I'll explain why in a second. There are some direct inflation hedges, stocks whose the price of their product goes up with inflation. Transurban is the obvious one in Australia. There are some other companies where they can pass on any price rises relatively easily because the customer is sticky. They can't get out of the products easily or they don't want to. So some of the small cost subscription services can usually pass things through. So Spotify, I think, qualifies for that. Netflix is a bit expensive, I think, but clearly that would qualify for that, as do some of the other streaming type services, because you don't miss the extra dollar out of your pocket. Don't forget, these guys have inflation inputs too. They're called people. Right? So if wages go up, these guys get squeezed as well because, apart from, in their case, the cost of rights, they also have people offerings as well. So you need to be looking at companies that can pass on through their business model any of their input cost increases. And of course, you can play in the input stocks themselves. So I have a very long duration stock in Terra Resources, which we touched on back in January, which is now an ore producer.
Now, Andrew, we could talk about inflation all day, but we're seeing some big changes in the listed investment company market. And, you manage a listed investment company on the NSX, and so we wanted to get your thoughts. We've seen big mergers with, Jeff Wilson's Global Fund taking over the Templeton Global Growth Fund, and also Soul Patts and Milton. We're also seeing a number of LICs move over to active ETFs. Magellan announced one last week. So what's your take on the LIC landscape at the moment?
Okay, well, I'll take this. First of all, Soul Patts and Milton are both internally managed, and effectively Soul Patts and Milton are both internally managed, and effectively Soul Patts really controls Milton. So it's really a merger of two very like-minded companies. For Milton investors, they're going to really get away from a bank hefty portfolio into a much more diverse asset-based portfolio in Soul Patts. So that's very friendly. It's all internal. I don't read too much into that. The Wilson TGG one is a bit more interesting. It's Jeff Wilson's company, Wilson Asset Management, is the preeminent external manager of Australian share portfolios in the LIC space. He's now basically moving into the global space. There's no real issues there for him. In Australia, there would be if it was more Australian assets, but it's global, so he's got a much bigger playing field to play on. The key here basically is Jeff's company's established a very strong track record over the years, and it's just more funds under management for Wilson Asset Management, so it's more money into Jeffrey's pocket. It's really as simple as that, and if he can continue to do that, and he'll only be able to continue to do that if his investment performance remains good, and of course that's not been an issue so far. If it were to peter out, there'd be a problem. In a wider sense, what I think it shows is that internally managed vehicles are generally better if they're going to be LICs. And it also shows that LICs must manage their capital, so buy back stock at discounts. And it tends to be internal vehicles that do that rather than external vehicles because, of course, that steals money away from the external investment manager. There's no question the ETF model is perhaps a little better, but I still do think there's scope for internally managed listed investment companies, providing the manager has a big interest in it and provided they manage capital properly.
And Andrew, just before we go, because unfortunately we have run out of time, but we must get your quick thoughts on the Sydney Airport announcement today. I remember when we had you on the show mid-COVID or earlier this year, it was certainly on your watch list as a potential turnaround What are your thoughts? $22 billion takeover bid or offer from a consortium of super funds and investors. What's your thoughts?
Look, in the long term, the bid's probably not quite big enough, but clearly, over the near term, there's still going to be some, hiccups to get over for Sydney Airport. What it does show is that the not-for-profit funds, who are one of the key players in this, have got so much money they don't know what to do with it. And I think one of the key issues for people to look out for is that some of these not-for-profit funds are getting very, very big indeed, with a lot of cash, and there's potential for them to make mistakes. And if they bid too much for Sydney Airport, that may turn out to be a mistake.
Well, I know that there's been a lot of chit-chat in the Equity Mates community over the last couple of days about it, so I'm sure they will appreciate hearing your thoughts. But that is all we have time for, Andrew, so thank you very much for sharing your time with the Equity Mates community here on AusBiz. We'll have to get you back on the show at some point to review our bold predictions that we made at the start of the year.
Absolutely, and it's always a pleasure to be with you two guys. Thanks indeed.
Thanks, Andrew. Well, that brings us to the end of today's episode. Hopefully you got something out of that was helpful for your investing journey. Always a lot to talk about around inflation. And if you would like more info on the listed investment company mergers that are going on, stay tuned because we do have an episode about that coming out next week. Or was it yesterday?
On the podcast?
On the podcast,
next
week. Yeah. A lot of content going on.
Yeah. And if you want more content, stick around with us this week. We've got Watchlist Wednesday tomorrow with AusBiz favourite Andrew Page. And then we're closing out the week with an interview from the Managing Director of Future Super, Adam Verway, on the state of ESG investing. So a big week here. Looking forward to having your company tomorrow and Thursday.
Can't wait.
Equity Mates, from our mates at Spaceship. Investing made easy.